I'd say, given the volatility we've seen in markets this year, relative value has been evolving pretty fluidly. And so, right now, I'd say the preferred areas where we're seeing good value in the market as a function of repricing of interest rate risk and as a function of corporate spreads or credit margins widening as the market needs to price higher probabilities of recession on a forward-looking horizon, is that you can go into higher quality ends of the credit markets and get better value. So triple B corporate credit in the U.S. market is attractive to us today. Things like the telco sector in particular. Not only have you had widening of interest rates or rising yields and widening spreads, but you've had a lot of issuance, new issuance, which has created kind of a technical distortion in that market. Other areas, high quality ends of the high yield market. The mortgage market is also presenting some opportunities of value now that spreads have widened, and even things like mortgage credit are starting to present value. Combination of macro factors, rates, and supply, creating better pricing in those markets and better protection against downside forward looking. So like the telco sector, stable cash flows. There's been a lot of new issuance from telcos this year on the backdrop of yields starting the year. They're tight, widening as a result of yields and rates going higher in the U.S. market. And a lot of these names we think are strong triple B credits. Management teams been very clear that they don't want to have the company downgraded into double B. So there's a desire from management teams, their incentive for management teams to stay triple B. And their bonds have weakened significantly this year, partly due to new issuance in a more volatile market backdrop. The mortgage market, we think that's starting to look interesting. You've seen widening in mortgage spreads as a result of concerns in the market around interest rate volatility. So commonality here of interest rate volatility cheapening a lot of things, but also quantitative tightening and the implications that that's going to have as the Fed steps away as a big buyer in the mortgage market. You have to ask yourself what's already in the price, and in our view, some of that's already in the price and hence offering better value. Let's start with like now versus the last year or so. We really, through 2021, starting in 2021, came in with pretty aggressive risk posture. We felt it was a conducive environment to take risk. We are near our strategy's maximum allocation to high yield credit, for instance. And the regime of 2021 rewarded that, which was volatility suppression, central banks that were still accommodative, and strong underlying credit fundamentals in those markets. As we got into the second half of 2021, 3Q into 4Q, our outlook was changing. And the outlook before 22 started was one of, while fundamental growth may still be resilient and strong, consumers are good, the corporate balance sheets are good, the macro landscape's changing, in particular the Fed, in particular central bank policy. And volatility suppression of 21 was likely not the case in 2022, and interest rate directionality would be challenging. Yields rising is just challenging for a broad swath of bond markets. And so we reduced risk in our portfolios coming into late 21, put a lot of those proceeds just really into cash and cash equivalents to have a bit better ballast as we entered 2022 and to be more able to allocate to dislocated opportunities like we just discussed, triple B telcos, mortgage paper. But we're also cognizant that we're not in a rush to get back to the risk budget of 2021, which was high for a certain reason. So it's, I think, more nibbling at opportunities, tactical management, looking for areas of significant dislocation and redeploying gradually into those opportunities is, our mentality, I think, over the course of this year. Very similar to kind of like if you draw back all the way to March of 2020, very similar kind of dynamic. Came into that environment, it was late stage cycle, COVID hits. A lot of our portfolio existing was well underwritten credit. We weren't reaching for yield at that point in the time. So when COVID hit, we entered with moderate risk budget. We had some degrees of drawdown, but important was that those drawdowns were more marks than reflections of impairment on our existing positioning. And we had suitable liquidity to raise through our treasury positions to be better buyers, again, of dislocations that emerged in that period of time. And it's very similar. We were buying high-grade credit at the start of the crisis, high-grade mortgages at the start of the crisis. It was the first area of deployment, particularly as the Fed started to step in and support markets and liquidity. So, all sums up to our approach. Really focused on relative value and prudent risk management coming into these environments, and being able to be better buyers of risk at the right times to enhance income and enhance returns over time.